Hey everyone, Steve here from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ish collective. Today we're going to talk about the Rocket Company, a company that just went IPO and has really done very well on their last earnings. The stock went down and a lot of you are curious about why and whether this business is worth investing in or not. So in this video, we're going to talk about the pros and cons of investing in the Rocket Company. And we're going to talk about why I think it's actually a pretty good investment for a long-term strategy. But right now, the point of entry is pretty bad. And it has to do with the macroeconomics. It has nothing to do with the company itself. So if this is the type of content you've been looking for, please spank that like button for me and let's get started. First and foremost, if you're familiar with Quicken Loans, the Rocket Company basically is Quicken Loans. The Rocket Company, on a very high level, is essentially a holdings company of a ton of subsidiaries that has everything to do with loans and insurance, basically the end-to-end workflow of getting a mortgage. They also actually have some business around the auto industry as well. But in this video, we're gonna stick with the mortgage related stuff because that's how they make most of their money. According to Forbes, the Rocket Company owns about 10% of the entire market cap for mortgages. And the majority of their business, a little bit over 70%, is around refinancing as opposed to getting loans for the first time. This makes a lot of sense. If you ever gotten a house before, you'll realize that most loans, new loans, are gotten based on the recommendation of the realtor themselves, not a self-service tool. So essentially, your realtor will recommend, say, hey, if you're interested in loan, I know someone great, let me introduce you. And you go through this experience. And through my 10 years of house hunting and buying properties, in this industry is very much good faith-based. And so they have to make sure that their recommendation is great. And I've never had a problem, right? What's interesting though is that it makes sense that 70% of their business is around refinancing because I've refinanced before as well. And it's then that you start doing the self-service model where you start Googling, how do you refinance? Where do you go to refinance? That kind of stuff. On a macroeconomics level, there's actually two reasons why this type of company is doing very well right now. And it has to do with inflation and the interest rates. The interest rates are super low. So that drives people to look for a house to buy because you start getting into this whole, it's not that expensive to buy compared to rent territory. When that happens, people start buying like crazy. This also incentivized investors like me, who is looking at the market and seeing that interest rates are super low, so that I'm paying less on top of the actual cost of the property. So therefore, I'm looking around to buy a property, right? The other reason is inflation. When more money is pumped into the market, inflation happens, which is undoubtedly happening right now. And because of that, a lot of people are preparing to buy physical properties, physical investments to offset inflation, because if you're holding cash, the money will become less and less valuable. But if you hold physical goods that appreciate in value over time anyway, then it's going to appreciate in value faster. So real estate, gold, silver, a lot of natural resources kind of stuff, that kind of thing. If you buy a car, that's not a physical investment at all, okay? Just so we're clear. And if you're looking for a more expertise opinion around real estate, I recommend two YouTube channels. Manny is a really great channel, I'll link below, and Graham Stevens, because his name is Steven, and I'll support any Stevens even though he spells his name wrong. Those two are complete veterans around this space and will know way more than I do, and they've already put out a lot of content around this idea of inflation, the real estate market right now, and how it's affecting us, and also how it will, change the way people invest and look at real estate in the next 6 to 12 months. So I highly recommend those two channels, especially right now. The second reason I think that we're having a real estate boom right now and that it's going to extend a little bit further is the fact that remote productivity, working from home, is becoming more accepted. We can see that in SF, there's basically an exodus of people leaving, right? A ton of my friends, basically all my friends are in tech, but a ton of my friends are moving to Colorado and Ohio for the same reason, You get great views, you get much cheaper rent, and you get to stay closer to your family. These are huge incentives for people to move out of where they currently work. And again, it's happening. So these three reasons, inflation, interest rates, and the acceptance of remote productivity, is creating the boom that you see, allowing companies like Rocket to be able to capture a lot of revenue. The challenge is that this is what's happening, and the stock market tends to reflect what's going to happen, right? And again, I keep drilling this idea to you guys, even though some of you don't believe me. This is a pretty accepted view in the professional investor circles that I speak with, where we are in a bubble. It's debatable whether we're at the tail end or the middle of the bubble. So that's the thing I debate against. And that we are essentially near a recession, because recessions are cyclical. You can literally see the trend. You can prevent it from happening sooner than it's supposed to, but it's eventually going to happen. And the fact that we're pumping a shit ton of money in even before COVID and now during COVID, that is basically prolonging the inevitable. And what I'm really saying is that institutional investors are looking at the market, knowing that this is going to happen, and they're thinking that because the market is going to crash, real estate market is going to crash as well. When that happens, people like me and Manny and probably Graham Stevens, we're waiting for this perfect opportunity to buy on the cheap. But we're not completely sure when that's going to happen. It could be a year or 2 years, but it's definitely not like in 3 or 6 months, right? And because of that, I'm holding back. I cannot invest in a company like this because even the CEO of Rocket themselves said that the trend looks like it's slowing down. And if you don't believe that the recession is coming, another objective way of looking at this is that right now the interest rate is way lower than ever before, right? And that we already know a shit ton of refinancing is happening. I mean, Graham Stevens himself did it in one of his videos. If you think about it, it has to be significantly lower again for someone to refinance again. You're not going to refinance in a row like over and over because there's a cost incurring. The amount of money you're saving is going to be less, right? The next time you refinance, it has to be a significant savings compared to the one before that. And so because Rocket's main business is around refinancing, and that I don't expect people to refinance, then yes, I completely agree with the CEO's sentiment that their overall trend is probably going to be a little bit less. We don't know how much less, but we know it's probably going to be less, and therefore that is a negative expectation, and that will lead to the decrease of the valuation of the company's stock price. The real estate market is the investment opportunity that all of us investors who are successful at it eventually go into, because that's the best way to protect your money, the best way to create passive income. There is so many benefits, tax benefits as well, and also it's the American dream to buy a property. So there's many reasons why the real estate market will always be successful if you invest into it for the long term. But all I'm saying is that in terms of point of entry, I feel like we're at a high right now. And if you buy into a company like, a company that does mortgages, you're basically buying at the peak. And so this is why, based on my analysis, the business is doing very well. But because of the uncertainty that's coming up, I will not invest in it right now. The key caveat for real estate markets in general is that it's a slow moving beast. And so I really do think that you'll be able to see the trend coming before the stock value is going to go up the next time. And therefore, it's going to create a very clear buying opportunity in the future. Unlike tech, which is quick, abrupt. You either miss it, you get it. All right, guys, so I hope this makes sense. If you have any questions or concerns, please leave me a note. I know what I've just said is not great news for some of you people in the 11ers Collective, but my thought process and my analysis have worked for me. It may not necessarily always be right? I definitely am no oracle, but it's just one additional data point that you can leverage for your vision and how you build your own portfolio. So always take what I say with a grain of salt. If you have any suggestions or questions or requests, please hit that subscribe button and leave me a note. I'll definitely respond. Thanks for watching, and I look forward to working with you next time.